Do you treat investing in bonds like a kid eating broccoli? You do it because you're told you have to? I get it. They might not look very appetizing at first glance. But bonds aren't the drag on your portfolio you think they are. In fact, they can actually boost your returns in the long run, as this fixed income whiz will soon explain. Prepare to rethink everything you thought you knew about this portfolio staple. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I'm looking forward to busting a pervasive investing misconception that bonds are necessarily bad for your portfolio returns. Like many things in finance, it's not quite that simple. So let's dig into the details to find the truth of the matter. Joining us is Adam Engel. He's the Vice President of Retail and Wealth Distribution for FX, Fixed Income, and Precious Metals at TD Securities. Adam, it's great to have you with us in studio. Thanks for taking the time.
Thank you very much, Rob, for the opportunity. I really appreciate it, and I look forward to discussing with your listeners on why they should have fixed income in their portfolio.
Yeah, it's a great topic, very timely, certainly. I have to say, Adam, your title, even by TD standards, is a long one, but that must mean that you're an important guy. So we appreciate you taking the time to join us. A lot of our viewers are probably familiar with bonds, but for those who aren't, can you maybe just give us a quick rundown? Like, what is a bond? How does it work in a nutshell?
Of course. So a bond is a loan from an investor to a borrower. The borrower agrees to pay the principal with interest at regular intervals during a set period of time. And in return, that borrower gets upfront capital for their expenses. A borrower would typically be a government or a corporation.
Mm-hmm. Yeah, those are the two common ones for sure. Okay, so that seems simple enough. You kind of think of it as like a loan. I think a lot of people would be familiar with that concept. What are the benefits, potential benefits of holding a bond?
Yeah, so top of mind, it would be preservation of capital, predictable income, and diversification benefits. There can be some negative correlations between stocks and bonds, more correlation to government bonds over credit.
Yeah, I think a lot of people are familiar with stocks and why you'd want to hold those, but maybe unpack a little bit for us some of those benefits, just so people understand a little bit more detail.
Sure. So in terms of, which?
All three of them. Just give us a little bit better sense that you mentioned.
Yeah, so capital preservation would essentially mean, your hard-earned money is being put to work, and when you need that money, you're able to get it, if you have any liabilities coming due in the near future. Whereas stocks, you have a chance that there could be a drawdown, and when you need that money, you could be selling at a loss, an inopportune time. With predictable income, when you buy a bond, you basically have a coupon and a principal repayment. So you know exactly what your yield is when you buy the bond. So that is, it's considered very secure and stable. And then with lower volatility, so looking at the market today, there is certainly some headwinds. There's been something happening in the news where equities are slightly down. If you look at the government bond yields, they're actually rallying right now. So if you were holding a long-dated bond, that would actually hedge some of that that would hedge some of the loss that you would have experienced in the equity market. So it's definitely a tool that you can use to diversify and keep your returns kind of smooth and stable in the long term.
Yeah, fantastic explanation, really lays it out. I think a lot of folks out there probably wrote off bonds for dead, just given the crazy bull market that we had and the super low interest rates that we saw, but things are changing now, right? Times are kind of normalizing a little bit in some sense. So that's the good. What about the bad, the potential bad, the risks involved with bonds?
So the bad would be, COVID era. When that happened, rates were near zero, and then inflation was running rampant at high single digits. And for investors that had government bonds or any sort of bond at that time, they were probably locked in around 2%. Meanwhile, inflation's at 6%. So there's a real erosion in your wealth because the goods and services are increasing at a pace faster than what your rate of return is. So inflation risk is definitely a risk that you need to consider when investing in bonds. Next would be default risk. So that would be more prevalent in corporate bonds. So when you buy the bond from the corporate business, you want to make sure that they have a solid balance sheet than the cash flows, so that they're able to pay back their obligations and they don't become insolvent and bankrupt. And then lastly is interest rate risk. So if you were to buy a long-dated government bond, say like 30, 40 years out, to use as a potential hedge on your equities, if you need to sell that bond in, say, 10 years' time, you're really subject to the interest rate environment at that time. If interest rates rise during that period, you could be selling at a potential loss, because with longer dated bonds, you have more duration risk. So as interest rates rise, there's an inverse relationship between interest rates and bond prices. So your bond price could come down, and then when you need the money, you might be selling at a loss. So those would be the three primary risks with investing.
Yeah, I think a lot of investors are very familiar with the inflation risk, certainly, that we saw. And that was a key one that I think had a lot of people down on bonds. But as we're going to discuss, it's a little bit better for bonds now, and they're not necessarily the drag that people might think. So let's get to the heart of our conversation. Of course, answering that question, are bonds actually bad for your portfolio returns? For those in our audience, if you want to get in on this conversation, we'd love to have you. Make sure you submit your questions to us. If you're watching on Webroker, it's the chat box you want to use to send those questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It'll take you over to our broadcast platform, and that's where you can ask your question. Okay, Adam, so let's get down to brass tacks here, to attack this question right on, because I think it's no secret that long-term stocks have higher expected returns than bonds, right? I mean, that's been the case for essentially all of history, for the most part. So are bonds bad for your portfolio returns?
Yeah, so I wouldn't treat the two as mutually exclusive. I wouldn't go 100% stocks, and I wouldn't go 100% bonds. I feel like they work in kind of unison. I would treat fixed income more as a complement to your equity holdings. So, treat bonds as, a way to preserve your capital and get a predictable income stream. And, depending on where you are in your, investment career or how old you are, that would change your allocation to fixed income. Generally, when you're younger, you want to have a longer, a bigger exposure to equities and maybe not so much to fixed income. And if you are an older investor and you're worried more about your capital because you'll need it for your everyday expenses, you might want to have a higher allocation to fixed income.
Right, like what I'm taking away from here is it's a little bit of like a theory versus practicality exercise here, because if you look at things like solely on paper, sure, like stocks give you better expected returns, but we're not robots. Like, we're real people. We have real needs for the money that we're going to get. And so therefore, because stocks can be more volatile, maybe bonds are sort of the instrument that helps kind of blunt that impact in your portfolio. Is that like a fair way to look at things?
Yeah, of course, Lee, of course. And with the dampening and volatility in the portfolio, there is, it kind of takes out the emotional aspect. If you're heavily invested in growth stocks and there is a big market correction of like 15, 20%, you might make irrational decisions. With fixed income holdings in the portfolio, you're not going to see quite a drastic drop. And if you did experience your growth stocks dropping while holding government bonds, it might be a good opportunity to even change your reallocation. You could start selling your bonds to buy the dip. So there's definitely some interplay.
Yeah, so you have sort of like almost like an opportunity fund in your bonds, if you will, right, to take advantage of market dips and potentially save yourself from making some very human decisions in the midst of panic, right, which I think is really fair. I think a lot of people can relate to the volatility concerns that we've been seeing. I know there's a lot of talk right now about potential AI bubbles, stocks being overvalued. I'm thinking mostly like the S&P 500 and the NASDAQ and stuff like that, since that's where most of the conversation centers. Do you think then that it's an opportune time for investors to potentially consider pivoting more to bonds right now, given where we are with rates and given where we are with some of these concerns about the stock market?
Yeah, that's a fair question. And the rates have increased drastically over the last 10 years. So it's a much different environment. It's a normalized environment. There's no longer inverted yield curves. You're actually getting compensated for holding these bonds. You're earning a rate of return that's higher than inflation. So I think that people that have shied away from bonds should definitely consider adding it to their portfolio. And when you look at the performance of the stock market over the last 10, 15 years, pick an index, pick the SPY, pick the Dow, pick the TSX composite. Everything is up and to the right. It almost looks like a rocket ship. If you've participated in all that upside and you've made so much money, it's not a bad decision to maybe, okay, I need to take some chips off the table and kind of lock in that with a bond, where you know exactly how much money you'll be receiving and you know that your principal will be repaid.
Yeah, I think a lot of investors may be lulled into a false sense of security with just how like rip-roaring the bull market in stocks has been for a long time. But it's not always that way, right? And when it's not, it might be nice to have some diversification. They call it the only free lunch in investing, right, for a reason. We referenced broccoli earlier in the show, so I'm going to talk about lunch too. I want to get yeah, exactly. I'm going to get your take on something. Vanguard came out with a pretty bold call a while back, talking about how they think that a 30-70 portfolio, 30% stocks, 70% bonds, is going to outperform the traditional 60-40 portfolio over the next 10 years, in part because of these overvaluation concerns, in part because interest rates are higher now, so bonds have more attractive yields. A lot of people had their heads turned when they saw that forecast. I'm curious, what's your take on that? Like, is that outlandish to you, or is that within the realm of possibility?
Well, speaking from an investment standpoint, Vanguard made a very bold statement, and I think it's a very bearish outlook on the economy. And it's very scary if that was to come into fruition. I personally look at the glass half full. I'm more optimistic on the economy. I think that with AI, there's going to be a lot of productivity gains that haven't been realized as of yet. But I think fixed income certainly still has a role to play in that. You treat fixed income as a tool to kind of preserve capital and dampen volatility. It's really not that complex when you think about it. I think fixed income should be in everyone's portfolios because it's a way to just kind of erase that emotional, irrational decision making if you do see the market coming down in a material way.
Yeah, the idea here basically that bonds can kind of save you from yourself to some extent, and then overall by avoiding bad decisions, you end up getting better returns overall potentially, right? I mean, I think that's, to summarize, that's kind of what we're getting at here, right? Exactly. Okay. Now the other thing I sort of want to touch on with bonds and volatility in particular is we hear that bonds can like we were saying, dampen some of that volatility in your portfolio, particularly for those who don't like to stomach so much of it. But the sort of read-through in that is that, well, if you can stomach volatility, you don't need bonds. Is that a fair assessment of things, or is it more complicated than that?
Well, I would say it really depends on your investment goals. So if you have any short-term liabilities coming due, so for me, for example, I'm potentially purchasing a second property, and I have to come down with a down payment. And should I roll the dice and have all my portfolio in the stock market and then when I need the money, hope that it's higher or the same price it is now? Or do I want to lock in that money with a rate of return that I know will pay out on that particular day when I need the money? So it really comes down to risk. I'm a risk-averse investor, but I will always take that return if it makes sense. And with short-term liabilities, I feel like bonds would be the more effective tool to make sure that when those liabilities come due, you have your money ready.
Right, almost like a bird in hand is worth two in a bush kind of thing, right? Like you could roll the dice with stocks, but then you might not be buying a home when you want to buy a home, right?
Exactly. So, You'll just go further away from your goals, potentially.
Right. Yeah, it makes sense. And I can envision a retiree who wants like regular income from their portfolio, maybe seeing bonds is a good fit too. But speaking on the other end of the age curve, young investors. Okay, we've spoken to some young investors in the past who say, bonds not for me because I'm young. I don't need them. What's your take on that? Do they have a place for young investors, or are bonds, in the least pejorative sense I can say, an old people investment, basically?
Yeah, well, I definitely understand as a young investor looking into the market, equities have certainly outperformed fixed income. Like, there's no doubt in that. But as you're younger, you have a long time horizon. Certainly, you can withstand the market cycles, but there are certain liabilities that come due in the short term. And like if you have a tuition payment or a car payment or a down payment, fixed income would be a great tool for that. So especially now that rates have risen to the levels they are now, you're getting compensated buying a bond. Before, it wasn't the case. So I really think that as a young investor, they should definitely consider it. And if they're not comfortable investing, then they can always look for, they can always monitor the market and look for opportunities to kind of jump in.
What do you think about the bonds versus GICs, dilemma, I guess, for someone who has like a relatively short-term goal? Like, what's the advantage of bonds over something like a GIC?
Well, most GICs, they are locked in, so you don't have any liquidity. So you aren't able to access the cash during the life of that GIC. With bonds, we offer secondary markets. So you're able to sell prior to maturity, but then again, you're subject to where interest rates are at that time. But if you have a shorter term bond, then there's less interest rate sensitivity there. But so I would say kind of having more liquidity would be a very important aspect when looking at bonds versus GICs. And I'm not a tax professional by any means, but I know that there are certain marketing campaigns done by different banks that treat bonds trading at a discount as a very tax efficient strategy, because when you buy a bond at a discount and it matures at par, that adjustment or that delta would be considered as a capital gain. So you could potentially be investing in bonds on a tax-adjusted basis that would be higher than a GIC.
Right, yeah, and capital gains one of the more efficient ways to get taxed on your investment income. So that's a nice little feather in your cap. Nobody likes to pay more in tax than they have to, right? I want to throw an idea at you that we heard from Ben Felix from PWL Capital a couple years back. He was suggesting that bonds can actually be riskier for an investor who has a long-term time horizon, some kind of long-term goal, maybe saving for retirement or what have you, than stocks would be. And he was kind of citing some research. So let's hear what he had to say, and we'll get your take on it.
The big risk for a long-term investor is that their investments don't end up earning enough of a real return, a return adjusted for inflation, to meet their future spending goals, their future consumption goals. Over that full life cycle, they found that if you were investing in cash the whole time, you had to save way more and had a much higher probability of running out of money. And bonds, unless we're talking about a 30-year real return bond, bonds are riskier than stocks.
So, Adam, what do you think about this idea? We were talking about how bonds can have a place for a more short-term goal, but what do you think about what Ben is saying, that they can be a risk in terms of not being able to actually reach your investment goal if you have a longer-term goal? Is that a fair comment, or again, is it more nuanced than that?
Yeah, so if you buy a long-dated bond, you're definitely tied to the interest rate at the time of purchase. But if you were to buy a bond ladder, you would have the ability or the flexibility to reinvest into, so we'll go into a bond ladder later, but if you were to buy a bond ladder, you reduce that interest rate risk, because as the bond maturities come due in the ladder, you would roll it forward to the long end, and then you would be able to capture a higher interest rate. So by incorporating a bond ladder in a portfolio, you kind of mitigate interest rate rises. And I'm not going to fight them that equities have outperformed fixed income, but again, coming back to fixed income being a diversification tool for equities is definitely very important to consider, especially in today's environment.
Yeah, and we can see on screen here we have an example of like a bond ladder, like how you were saying you have different durations of bonds, and then you're rolling when one expires and you get, or matures I should say, and you get your money back, you invest it into another one that goes at the end of the ladder, and you're constantly sort of shifting it forward like that. So this kind of gets back to your idea of like having a little bit of optionality too, right? Like you get a little bit of money that comes due and you can deploy it in wherever you think is the most effective place.
Exactly.
Yeah, I think that makes sense. A bond ladder is a great tool. Just a quick note to our audience, we're going to tell you a little bit more about bond ladders later in the show, so stay tuned. But for now, one of the things that I know a lot of skeptics were saying about bonds is that when they think to 2022, which was a rough year, stocks did poorly, bonds did really poorly too. And I think a lot of people felt kind of cheated by that. It's like, bonds are supposed to take the edge off of these stock losses, and here they are, they're down in the dumps with them. What happened? And what would you say to a skeptic who's like, look, why would I go to bonds if they're going to let me down when I need them most?
It's a very unfortunate, experience in COVID times. It was a black swan event. Governments essentially shut down. There was like helicopter money, and there was inflation that was coming in at like 7-8% in North America. If you were invested in bonds at that time, you would have been losing on the inflation risk. So there's, definitely during that time, there was a more positive correlation with bonds and stocks. There was no place to hide. But, take now, for example, rates have come up. and they've normalized. And I would say we're close to the peak, and we're more in a rate cutting cycle. So, taking a snapshot then and now, there's been a material change. And now in a normalized interest rate environment, government bonds are seen as being more negatively correlated with stocks. And you're seeing that right now. If you look at the 30-year government bond right now versus the S&P 500, S&P 500's down, the 30-year's up. So good case in point, concrete evidence.
Right. So this is like truly like kind of like a more one-off kind of event where, because the bond rates were so low, it kind of created this perfect storm where, like, when things went sour, there was really like nowhere to hide, like you said. That said, I've seen, and we had it up on screen there, looking at the correlation between stocks and bonds. Like, typically it's negative, like you say, meaning like when stocks go up, bonds go down, and vice versa, generally, to simplify it. That trend has sort of changed in recent years. Like, they're more positively correlated than they were in the past. What's going on here? Like, why is that the case?
So when you say bonds, I feel like it's important to differentiate between what type of bond. So there's government bonds, and then there's corporate bonds. When you buy a corporate bond, you are buying company-specific risk as well. So if you buy a corporate bond, then you're more subject to whatever the stock market is doing in that time. Because if the stock goes down, most likely the credit spreads are going to widen, and you could be at a loss buying that corporate bond. When you buy a government bond, there's no company-specific risk, so you don't have any credit spreads widening. And when there's a risk-off environment on the stock market, where people see a safe haven would be fixed income. So they wouldn't go into a corporate bond. Potentially, they would be more inclined to go into a government bond. Right. So demand would flow from equities to government versus equities to corporate.
Right. People are sort of looking for the more sure thing, if you will, kind of thing, or at least the better bet, I guess, in that sense. What about interest rate risk? Because we talked about that a little bit earlier. How could somebody mitigate that? Apart from like a bond ladder, which was sort of one way to do it, is there something else that they could do to sort of mitigate that impact that changing interest rates could have on the value of their bonds, so that they can hopefully, I guess, squeeze a little bit more return potential out of the bonds that they do invest in?
Yeah, so a common misconception with bonds is that there's always going to be interest rate risk when buying a bond. If you buy a bond, at that point in time, if you hold it to maturity, you have already locked in what that rate is. So if you plan on holding that bond to maturity, any interest rate movements that happen during that period is essentially just noise. Because you'll receive all those coupons plus the principal repayment. You've already locked that in. So holding to maturity is one option. Second option is simply reducing your duration. So there's more interest rate sensitive bonds as you go further out in terms of maturity. So you'd want to have something with shorter duration. So you want to invest in bonds that are maturing only 2-3 years out. Because if there's change in interest rates there, it's not going to have as big of an impact on your bond price.
Right. Okay. So that's great. Some news you can use, so to speak, on like how to mitigate that risk, because that is a key one. Appreciate that. We've been talking about bonds as sort of like this tool. Let's talk about how to put those tools to use in your actual portfolio. And actually, a colleague of ours, Trevor Cummings, who was on the show back in December, he had this really interesting idea that he floated called the bond triangle. And we have a graph of this that we can put up, and we can kind of talk through it a little bit. But the idea here is that there's 3 points of a triangle, and each one of them kind of represents a different aspect of what a bond offers. So you have risk offset, this is giving you essentially diversification from stocks. You have the stability, the less volatility versus stocks. And then you have yield, what income that you're getting from your bond. The interesting point that he made was that the closer you get to any point in this triangle, the further away you get from the other points of the triangle. So knowing that, what are some sort of general tips that investors should keep top of mind when they're building a bond portfolio?
Yeah, well, I think it's a very clever way to understand, fixed income portfolio management. So that triangle, kind of summarizes all the goals and objectives when buying a bond. So it really depends on what you're looking for. If you want to chase yield, you're going to most likely go into a corporate bond. But with that, if there is a downturn in the stock market, you're not going to have that negative correlation. Your high yield bond would almost drop pretty similarly to the stock market. So you don't really have any protection there, and you lose stability if that corporation becomes insolvent. With stability, now I'm thinking like U.S. Treasury bills, Canadian T-bills. They're very secure and stable, but they don't really offer any sort of diversification in your portfolio, and you're not getting as much of a return. And then on the risk offset side, that would be your long-dated government bonds, where they have a very high duration, and you could be using it as a way to hedge against downturns in your stock portfolio. But you lose stability in the sense that if interest rates were to rise, that way to hedge your portfolio has just worsened. You've actually amplified the loss in a way. And then with yield, you've got to be careful because of the inflation risk when buying a long-dated bond.
Okay. So give me an example then, let's say a retiree, for instance, because a lot of retirees look to bonds. What sort of bonds, generally speaking, kind of make sense for a retiree's portfolio as opposed to someone who maybe is younger, they have a more specific goal that's shorter term. Retiree wants that stability. So what are they looking for? I
would gravitate to the right side of the triangle. Stability. So, you've worked most of your life, you're retired, and now you need to start drawing from all that hard-earned money that you've made. So you want to focus on something that's going to be secure and that's going to pay out regularly for your everyday expenses. So there's no need to go for higher yield or, mitigating any offsets in your stock portfolio. You're not really looking to accumulate. Now you're looking to withdraw from that hard-earned money. So I would naturally gravitate to the stability.
Okay, makes sense. And that's great to kind of walk through that example. I think that resonates with a lot of people, so it's great stuff. One thing I think a lot of people might wonder too is, ETFs are great. There's stock ETFs, if people are familiar with that. There's all kinds of ETFs, really, and there's bond ETFs. Why would somebody want to have a portfolio of individual bonds as opposed to just holding a bond ETF? Because that seems like it would be a lot more simple, straightforward.
I completely agree. But the reason why I'd want to buy an individual bond versus an ETF would be for a few things. First of all, you're not paying an ongoing management fee. So buying the individual bond, as you receive the coupon's repayment, you're not paying a fee every single year just for that management. And you do have more optionality buying an individual bond. You can kind of time your losses and your gains better, and you kind of are in more control. So you definitely have more control, but it could be operationally cumbersome. And then also buying an individual bond versus an ETF is you have the you can kind of stagger the maturities, and if there's any liabilities on the horizon, you don't need to sell any of that bond ladder. You can just wait for the maturity to come due, and then you can use that capital to then put towards your liabilities.
Right, okay. So yeah, you get this steady stream coming in, basically, is kind of how it works. You're talking about individual bond portfolio. I think a lot of people might think of that in terms of an individual stock portfolio, right? You have these individual issues that you have to sort of manage. How would you say, just generally speaking, in terms of research and the time it takes to manage an individual bond portfolio compares to an individual stock portfolio, which I think a lot of investors might be more familiar with?
Well, I would say it's a little easier managing a bond portfolio, and what I do is I make sure that all the bonds on the fixed income platform have sharp prices, and we want to show as much inventory as possible. So I would highly recommend any investor that's interested in buying bonds to take a look at the fixed income platform. Under that, we have a featured portfolio section where we have a Canadian core ladder. So we've already done the research for you. We've already included 5 primary bonds and then some secondary bonds if you want to mix and match. So when constructing a bond portfolio, you really want to look at your credit quality and you want to look at your duration. Those would be the primary things that you need to take, you need to be focused on. But again, highly recommend going onto the fixed income platform under featured portfolios and take a look at the Canadian core ladder as well as the US core ladder, because all the research is done. They're well-known retail names, and they will provide secure, reliable income when you need it.
Okay, so doing some of the legwork, I guess, for investors, that's great. And we're actually going to take a little bit of a dive inside that fixed income platform on WebBroker in just a moment. But first, to our audience, if you're enjoying the show, you're finding this educational, you're getting a lot of value out of this, then you want to make sure that you follow TD Direct Investing on social media. We're all over it. YouTube, Instagram, Facebook. You can see the QR codes on screen that you can scan to follow us if you aren't already. There's tons of educational content on there designed to level up your investing game. And you can also get some sneak peeks at some interesting episodes that we have on this show and others that we do coming up down the pike, so check it out. Our live viewer Q&A coming up in just a few minutes, so make sure you get your questions in if you haven't already. But first, I want to bring in my colleague Caitlin Cormier to show us how to research and trade bonds in WebBroker. Caitlin, welcome to the show.
Thanks, Rob. You know, this is one of the topics that's near and dear to my heart, so extra happy to be here today.
I know you love your bonds, so show us the bond magic in WebBroker. We were talking about bond ladders earlier. That seems like a great tool for investors who want to have some reliable income coming in. How can they get a sense of what they can expect from a bond ladder and how to build one?
Yeah, absolutely. So the bond ladder is one of the great tools in WebBroker that we have for building bond portfolios. I actually have it kind of started here. So let's go ahead and hop in and see what we're looking at here. So within the fixed income portion of our platform, you can just come to research under investments and click fixed income. And I've clicked on one of my portfolios that I've pre-created here. You can notice I have a few different bonds listed here already. Let me show you how to add other bonds to this list. I'm just going to go to the home section. I can choose any type of bond I want. Let's go ahead. I'm going to choose a provincial bond and we'll do maybe 0 to 5 years. So that just means it's maturing within the next 0 to 5 years. I'm going to go ahead. You guys know I'm a blue noser, so I choose Nova Scotia bond just for that purpose. Just going to select which portfolio, add to portfolio, and boom, here I am at my list. So you can see I have a few different bonds already selected here. I'm going to go in as if I am building a ladder and just put a dollar value here for each one of these bonds. And once I'm done that, I can go ahead and click Create Ladder Report. And it's going to give me a nice little report. It's just going to download it directly to my computer here. I can click on it, and it's going to give me some information about if I were to put this into a portfolio. So zoom in a bit. You can see it's giving us that, what percentage of the portfolio it is, what rating it has, the duration and term to maturity is listed there, your annual income, and it totals all of this stuff as well. So you can see the portfolio as well as the individual information. And if we come down a little bit further, just zoom out a tiny bit, it's going to show you when you can expect your monthly income, how your allocation is divided, your credit rating. So quite a bit of information on just sort of one quick sheet here. So just chuck some different bonds that you're maybe interested in building a portfolio. And when you come in, where to find those portfolios, if you just want to find them immediately, just over here on the right-hand side. Just go ahead and click on portfolio list, anyone that you've created, and you're good to create one of those reports.
This is fantastic, a great tool. We got Adam smiling ear to ear here because he played a part in getting this together, and he's been vouching for it. So we're going to give people a great look at a fantastic tool that we have here. Thank you for walking us through it, Caitlin. Really appreciate you joining us always. We'll get you back on for more bond conversation in the future. Don't you worry, all right? That was TD Direct Investing Senior Client Education Instructor, Caitlin Cormier. And Adam, you're talking about this is one of the newer features that you have on WebBroker. Tell us a little bit more about some of the upgrades that we've recently seen on the platform in the fixed income world.
Thank you so much, Rob. So we've undergone significant improvements, not to the user interface, but behind the scenes in terms of the pricing engine and the number of products that we put online. So about 6 months ago, we were only showing about 200 corporate bonds on the platform. Now we're showing upwards of 800 to 1,000 bonds on the platform. And before, it was only showing prices if the client was looking to buy. But now we're showing two-way markets. So we're showing prices for the clients to buy bonds and sell bonds. So you're getting more product, you're getting more transparency in pricing, and you're just getting an overall better client experience, because now there's less need for you to contact TD Direct Investing and get on phone with an agent to book a trade if you need to sell. So ease of execution has definitely gone up. through the roof, and we're seeing that resonate with a lot of the DI clients.
Yeah, ease of execution, greater visibility, like what's not to like? So that's fantastic. So thanks for filling us in on that. Now's the time that we're going to get to our live viewer Q&A though, okay? We're going to open the floodgates, see what people want to know more about. You ready to go?
Let's do it.
All right. Wendy is our first question. Let's see what Wendy wants to know. Wendy's saying, in the current environment, what would you suggest? Short-term or long-term bonds, individual bonds, or bond funds? So given what we know about the environment, Adam, what's your take on that?
So it depends on how active you want to be as an investor. I feel like with a bond laddered portfolio, you kind of get a nice blend of short term and long term. So if you have a bond ladder and it's like starting in year 2 and goes out to year 6, on year 2, when the bond matures, all you simply do is you take that money and you reinvest it to the long end of the curve. And that way you don't really have to continually manage interest rate changes. It's a simpler strategy, and it doesn't require as much research and risk if you get that decision wrong.
Okay, so here, yeah, you don't even have to worry necessarily fussing about like, is it better short term, longer term? You kind of get the best of both worlds sort of thing, right? Is that what I'm hearing?
Exactly.
Okay, so bond ladders, really popular tool here. That's great. Let's get to our next question. This one from Tyler. Tyler's saying, what are your tips and common mistakes to avoid when structuring a bond ladder? Okay, look at this. People are interested in bond ladders. Lay it on us, Adam.
Yeah, I love that. I love that people are more comfortable building a bond ladder, especially on the platform. So I would say some of the things when building a ladder is you don't want to buy bonds around the same maturity. You want to have it staggered. So the whole idea is you want to be able to just simply roll the maturities forward to the end of the curve. And that way, and if there's a change in interest rates, if interest rates are rising, you're able to lock it in at a higher rate of return in the long end. So I would say, stagger the maturities evenly. Don't have it be all concentrated, and also try to, have more diversification. Don't go for, all financials or all energy or all utilities. Try to have a good blend in the ladder.
Right, yeah. Not, again, leading into that diversification, like not getting too concentrated in your portfolio. We hear about it in stocks. It works in bonds too. So great tips to keep in mind. Let's get to our next question. This one coming to us from Amy and others. A lot of people want to know this. How do you view target date funds? Can investors rely on them to transition fully to cash at maturity? What risks or considerations should we be aware of? Lots of questions packing in there, Amy. 3-for-1 special. Let's pick this one apart, Adam. What do you think?
Yeah, I was under the impression that it would be one question per user, but I guess
it's okay,
not.
Amy. You can cheat Amy and others. It's okay. Don't worry about it.
So the way I view target date funds is it's actually something that we're constantly in competition with TDAM. So on my desk, we focus on selling individual bonds. And it's definitely very similar to buying an individual bond because you have a defined maturity date. But the one thing with one thing with target date ETFs is you don't know precisely how much income you're going to be receiving over the life of that investment. With buying individual bonds, you do. So there's some variance with buying target date bond ETFs, but I would say that buying individual bonds could be more attractive. But if you want something with like broader diversification, target date bond ETFs are very effective as well.
Okay, and then that was like a 3-parter. So maybe we could toss that question board back up just so that we can pick apart the other ones, because the target date was the first one. But we had the others, and I'll just kind of check really quickly here. Oh, here we go. Thank you. Can investors rely on them to transition fully to cash at maturity? Risks, considerations we can be aware of. You sort of touched on that a little bit, but I mean, I guess the one that sticks out to me on this is the risk aspect of things. Like, what is the risk with a target date fund?
Yeah, so within a target date bond ETF, it depends on what's held in that basket. So if you're investing in a high yield target date bond ETF, then there could be more risks where the underlying companies could be at default not able to pay their obligations. But if you want a government bond target date ETF, your risk of repayment become very small. So it really depends on what side of the spectrum you're investing within those target date ETFs.
Okay. So lots to consider there, but appreciate your perspective on that one. Let's get to our next question. This one coming to us from Alain, when comparing bonds and GICs, it seems that GIC yields are often more competitive than corporate bonds, despite the higher risk of the latter. Is that generally accurate?
So with GICs, you buy them at par, and you do receive interest, but all that income would be treated as interest income. As I mentioned earlier on the show, when you buy a bond, especially one that's trading at a discount, it might offer a lower yield, but on an after-tax adjusted basis, it actually might be better overall. So you have to really consider tax when buying bonds. But again, I'm not a tax specialist, so I wouldn't recommend going on what I say, but I have seen marketing material being distributed from other banks that do advertise buying discounted bonds for the capital gains.
Yeah, okay. And again, like capital gains, like we were saying earlier, one of the more efficient ways of taxing your investment income, and certainly interest income, like the worst, if you had to pick and choose. So. Yeah, a good consideration for bonds. Let's get to our next question. This one coming to us from Kent. Kent says, for younger investors, are long federal bonds worthwhile? They offer recession protection, but can drag returns and are very sensitive to interest rates. How should we think about the risks?
So with long-dated government bonds, I would say that in this environment, you're earning, in Canada anyways, if you're looking out 30 years, you are earning close to 3.5, 3.6%. So that's a pretty healthy rate of return. And if interest rates were to fall, if there was a recession and inflation concerns came down considerably, it would have a very nice overall impact on your portfolio because it would diversify from your equity holdings.
Okay, so for younger investors then, like long dated can make sense, provided they're willing to, like, I guess, essentially lock into that term. Not that they're locked in, but that their intention is to hold for quite some time.
Yes.
Yeah. Okay.
Yeah, they do have that interest rate risk, so you do have to be mindful that if interest rates do rise, you would see a negative impact to that position. But if you do plan on holding it to maturity, you're going to continue getting that 3.5%, 3.6% year after year, which isn't too bad of a return.
These are very forward-thinking investors, though, in that case, because I don't even know what I'm going to do next week, and here they are, you're investing in 10 plus 30-year bonds, so whatever, maybe more power to you. Let's get to our next question. This one coming to us from Brandy and others. What is TD's outlook on interest rates in Canada and the U.S. for 2026?
Well, that's a great question. So in Canada, we forecast the Bank of Canada overnight rate to remain the same. Going into 2027, we're anticipating the rate to reach 3%. Right now it's 2.25, so an additional 75 basis point increase. It may happen in the back half of this year, not too sure. But in regards to the U.S. Fed rate, with the jobs report yesterday coming in really strong, our forecasters were originally predicting for 3 rate cuts this year, and that's been reduced down to 2 rate cuts. So right now, the overnight rate is 3.75-ish, and we would predict the rate at the end of this year to be around 3.25, so about 50 basis point reduction.
Look at you just ripping these numbers right off the top of your head. That's impressive stuff, I gotta say.
I came prepared.
Yeah, clearly. I gotta say, I do not envy the guys who have to forecast what the U.S. is gonna do with their policy, because, man, that seems like a real crapshoot at this point. But in any case, thank you for sharing that. Let's get to our next question. This one coming to us from Ronnie. As a retail investor, how can I save costs when building a bond ladder compared with an institutional investor?
So I think it really comes down to how much you want to invest in fixed income. So institutional investors and retail investors are quite different in terms of trade sizes. So institutional investors can get sharper pricing. Retail investors, they're kind of subject to commissions paid through the dealer as a service. So if you're looking for sharper pricing versus institutional, make sure that when you buy the bonds, try to buy in larger sizes, essentially.
Right. So a little bit of a bulk discount kind of thing.
Yeah,
sort of.
It's a tiered-based system, just like foreign exchange. The larger amount that you invest, the better the yield will be.
Okay, yeah, that makes sense. Sort of like the Costco approach to buying bonds. There you go, right? I think that's all the time we have for our Q&A. So Adam, thank you so much for fielding all those questions. Great stuff. I feel like it was like fast and furious from all different angles, and yet you answered everything like a total pro. So we appreciate you kind of sharing all those answers, and as well as kind of just breaking down some of those misconceptions about bonds that people might have.
And can I close with some remarks?
Yeah, go for it.
Just for the audience, I want to make a football reference. So consider stocks being offense and bonds being defense. And a wise friend once told me that offense will win you games, defense will win you championships. And that's what you saw with the Seattle Seahawks beating the New England Patriots at Super Bowl. And the same thing goes with your investment goals. So stick with fixed income, it will reach your desired outcome.
All right, there you go. Spoken like a true football fan and somebody who knows what they're talking about with fixed income. That's right. Different sides of the investment coin to consider with stocks and bonds. Great stuff. Appreciate you sharing all that with us. And of course, to our audience, thank you so much for tuning in as well. Make sure you check out next week's episode because we got a good one for you. We are challenging a DIY investor and his portfolio. We're going to put him to the test. He's going to have just 15 minutes to share and defend his top investments against a skeptical host. Can he make the case and beat the clock? Well, you're gonna have to tune in to find out. That's all the time we have for this edition of Inside Investing. From everyone on the crew, thank you so much for watching. We'll see you all next time.